President Trump's nominee to lead the Federal Reserve has talked big about overhauling the US central bank. Kevin Warsh thinks the Fed is too large and mismanaging inflation. He's called for regime change and said he might need to, quote, break some heads. So are we set for a wholesale rethink of the Fed's role in the economy? Or is this just talk? And what could it mean for you and me? Let's try and find out. I'm Carmel Crimmins, and this is Reuters Econ World. Every week we go deep on the economic principles and ideas driving the biggest news around the world. On this week's show, regime change at the Fed. A change of guard at the top of the Fed is typically meant to be a no-drama event. Incoming chairs like to emphasise continuity with their predecessor. It's been that way ever since Alan Greenspan replaced Paul Volcker in 1987. But this time round, there's been drama galore. President Trump has made no secret of his dissatisfaction with current chair Jerome Powell. He wants things shaken up, a sharp drop in interest rates, and he thinks Kevin Warsh is the guy to deliver. So will he? Let's ask our own Fed guy, Howard Schneider. Howard, how are you?
Howdy. Fine, hanging in there.
Hanging in there at early o'clock. It's pretty early there, isn't it?
It is just turned 5 a.m. So yeah,
Oof.
Not so bad.
I thank you on behalf of everyone from Econ World. So, Howard, tell us, who is Kevin Warsh?
So Kevin is, Kevin is a very familiar face in kind of central banking and central bank analytical and intellectual circles. He was a Fed governor before for 5 years, from 2006 to 2011 under Ben Bernanke. So he was really, played, according to Bernanke's bios, played a pretty central role in the crisis response for the U.S. Back then during the housing market crash. He has really strong ties on Wall Street. His pedigree is from Stanford undergrad, Harvard Law, the years at Morgan Stanley in the M&A department there, then a few years in the George Bush II Treasury in the early 2000s. He was like, they called him the Wall Street Whisperer for Bernanke. He was the one that would sort of take the mood of what was happening and what would the response be to this program or that program. So he has a background there. Ever since then, he has kept his toe in the water.
Right.
Someone said more than a toe, through his affiliation with the Hoover Institution. Part of also Stanford University. He was almost appointed Fed chair in 2017, in Donald Trump's first term, along with the pedigree I just mentioned about the sort of central bank circles. He's got ties to Trump, family and political ties to the Trump family. He is married to the daughter of Ron Lauder, who was a classmate of Trump's at University of Pennsylvania Business School back in the day. And I believe that's correct. And been a supporter and fundraiser for him ever since. So they've got some connections there. And as Trump likes to say, he looks the part of a central banker.
Central casting good looks, Howard.
Central casting good looks. Tall, tan,
like all of us.
He is a scratch golfer, which I'm sure is Trump appreciates. So there's that too.
But he was traditionally known as a hawk, right? So someone who favoured high interest rates to fight inflation. Trump has hired him because he wants to get rates cut. So is he now a dove? Like someone who prefers lower interest rates, just to use that kind of central banking terminology, hawks versus doves?
Sure. So he would probably say, I don't like hawks and doves. And a lot of them say that now because underlying the idea of hawks and doves is what they call the Phillips curve, that there's a trade-off between inflation and unemployment, and that to get inflation down, you have to push unemployment up. And that when unemployment drops, inflation is price pressures are likely to build. There's a lot of debate about how the Phillips curve, how this trade-off works. Is there a trade-off, right? Yeah. And that's where you have hawks and doves. I think we should be here on the curve. We think should be there. His comments and writings from 2006 to 2011 as a central banker then were less about hawk dove, Phillips curve, inflation, unemployment, more about the balance sheet and
Right.
quantitative easing.
Hmm.
Now, he's had a very tempestuous relationship with quantitative easing
And
because,
just to explain to people
yeah,
what quantitative easing
bond buying,
is, right?
yeah,
It's when the central bank, when the Fed goes in and buys large quantities of
right.
bonds and issues banks with reserves like electronic money.
That's right. And listen, you can sort of tell somebody's sort of baseline state, baseline view about this as to whether they consider it money printing or just kind of supplying liquidity to the market. That's kind of the
Right.
anodyne version of it. Now,
And the Fed's kind of argument is it's providing sort of liquidity, as to use the market
right.
parlance, to the banking system to keep banks lending to each other, which didn't happen during the financial crisis when they gone and at
That's
the
right.
beginning of the COVID crisis. So it's a kind of an emergency response
Right.
which has stayed around, and that's what Kevin Warsh doesn't like, right?
Yes, and I mean, you could carry this, and Kevin would certainly carry it down, sort of almost philosophical
Mm,
lines. So I mean, the central bank is there as the lender of last resort. That's the classic Walter Bagehot, ancient, Bank of England
hmm.
formulation. You lend money at penalty rates to good credit,
Yeah.
so that anybody who has a going concern that is solvent otherwise, but facing a liquidity crunch, can go to your central bank, the bank of all banks, and get what they need to tide through the crisis and come out the other side still as a going concern, hiring people, producing stuff, and the economy is stabilized, right? That is
Hmm.
macroeconomic stabilization policy. So when the markets start to seize up, what the Fed realized it had to do was buy a bunch of bonds and just like throw a bunch of money into the system and make sure that everybody could walk in the door and that there would be cash and reserves out there. Kevin was okay with that the first time around, QE1, because he agreed there was a real market crisis
Right.
and it had to be resolved or the
Yeah.
whole thing would grind to a stop. What he didn't like was QE2 and QE3 and Operation Twist. As it got bigger and deeper and more sort of engineering like, we're going to trade short, mold the balance sheet. The whole aim of this is to keep down long-term interest rates, mind you, so
Hmm.
that the economy continues to function and get stimulus beyond what can be provided by Fed policy rates alone. He worried, look, we're distorting the market. We're adding to the money supply in ways that will eventually lead to inflation, and the whole thing stinks, and it's a bad idea. He never dissented, but he made his arguments known in the committee meetings, and eventually resigned. Sort of walked away
Right.
quietly and said, I don't want to be
Yeah.
part of this anymore." That's where kind of his hawk reputation comes from. It's not so much that he wanted to punish the economy with interest rates, because back then, interest rates were zero, and he was not coming in the door arguing for, hike, 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 even though there was no inflation risk, right? What he didn't like was the Fed's sort of growing role in the in the financial markets there, and what he thought, and wrongly thought, frankly, because this never generated the inflation he suspected. Um, but he really had two arguments. One, it was inflationary, and B, it's, puts the central bank as the only player in town and a growing presence in financial markets that, as a conservative markets guy, he feels should be, all running on
Mm.
market pricing for interest rates and deals between banks and deals between the capital allocation, and the presence of the markets should dominate. So he's been wanting to dial that back ever since. And, now he's going to be the chair.
Okay, quiz time. The Federal Reserve has 12 regional banks located in major cities throughout the United States. One of them is home to the largest known stash of gold in the world. So which one is it? Is it A, the Federal Reserve Bank in San Francisco, B, the Federal Reserve Bank in New York, or C, the Federal Reserve Bank of Dallas? We'll have the answer for you at the end of the show. Up next, we take a closer look at Warsh's criticisms of the Fed. Okay, so Howard, Warsh definitely thinks the Fed has got too big, that it's bought way too many bonds and he wants to shrink that. What's his
Yes.
other beefs with the Fed? What are his other issues?
Well, we do need to get back to the interest rate question
Yeah.
and the sort of hawk dove answer on that side of the ledger.
Yeah.
But his other beefs, look, he feels that, and I think some of this is reasonable and some of it is, there's a cottage industry of critiquing federal bankers, central bankers out there. And they are easy targets, right? Because they make a lot of decisions, and as they put it, we're never perfect, and we're often kind of fumbling around in the dark. Uh, if you take him at his word, he's suspicious of their models.
Right.
He's suspicious of the groupthink, what he calls the groupthink.
So how they actually analyze where inflation's at.
Yes.
He's suspicious of that kind of
yeah.
modeling. Okay.
Yeah, and
that's pretty fundamental.
well, it's fundamental, but as Jay Powell said at his last press conference after the last meeting, if you've got a better idea, bring it on. We have however many thousands of economists and PhDs, working at state-of-the-art levels. And, if there was a better predictor of inflation a year ahead that they don't know about, I'd be really surprised. And B, please show us. We're not.
Bring it on.
We're happy to adapt and grow and learn and be better.
Yeah.
So a little bit of this is sort of, kind of armchair analysis, like, oh, why didn't you pass the ball instead of running in that, just a U.S. football analogy. And
I get it.
You can armchair quarterback forever, and, you should have run right instead of left. That's all well and good. It's part of the game, but I think, it's easy, particularly in this day and age, to denigrate technocrats and say, oh, they don't know what they're doing. They sit up there, they, science, wow. Kevin's not like that. And he knows better, I think. Part of this is, you put some arguments together, and sure, their forecasting isn't good all the time, but nobody's forecasting is good all the time. And could there be tweaks and improvements? Sure. I think what his point is, don't rely on it too much. Understand that the numbers you're getting from the models are probably wrong. What does your intuition tell you? What else can we learn? Don't be wed to, Phillips curve arguments. But in fact, they know that the Phillips curve arguments don't work like they used to. And they've been living in that world really for 25 years at least. So there's that aspect of it. There's also the communication side of it. He doesn't think forward guidance, which was, really a buzzword, particularly through the 2010s, has much of a place. He thinks they maybe talk too much about the data and maybe talk too much about what they're going to do. And he hasn't put it in these terms, but I think he, probably has a little bit of nostalgia for the Greenspan, Oracle. I got all my secrets in the briefcase, and, you don't get to see them sort of central banking. Now, he's never said that, but he has talked about, sort of saying less about the future. And that sort of hints at a more Greenspanian approach. Whether he will come in the door and say, no more press conferences, or, not so many press conferences, or, to the 12 regional bankers who are outside the board of governors, don't talk so much, it confuses people. I don't know. I think that, this is kind of a genie out of the box situation in terms of Fed speak. And the markets like it. But, can he tailor it down some? Sure. I think that, this resolves possibly around one issue we haven't gotten to yet, which is his whole experience as a Stanford student back in the days when John Taylor was sort of doing his work on monetary policy rules. He hasn't ever said, I'm going to be a Taylor rule central banker and, use this to straitjacket my decisions, because nobody's going to do that to themselves, right? Because the world changes and the world is messy and the world doesn't fit a mathematical equation. And he's said all this. But what you can do is say, listen, if you want to know my forward guidance, check all these Taylor rules out.
Can you explain what the Taylor rules are?
Sure. Sorry. So John Taylor, an economist at Stanford University, basically said that central banks kind of operated or seem to operate with a basic, you could just sort of set up an equation that said, what's your
Right.
inflation target? What's the distance between unemployment and what you think is its sort of maximum level? Where's the economy operating versus its potential? And what's your inflation target? And if you set this up, and you could put different coefficients around all
Mm.
these Greek terms, and it'll spit out an interest rate. And it really matched well what the Fed did, right, through different periods. And it's matched what other
Hmm.
central banks have done. And then the debate is, well, can this be actually a prescriptive
Yeah.
thing? And that's the rub. Some people say we should have more use of rules. And the Fed does use rules. It uses a lot of rules. There are half a dozen. It doesn't take away your judgment, because what you put in that equation kind of is at your discretion. But if Kevin Warsh wanted to change forward guidance, he could say something like, here's a half dozen rules that we're referencing, and that should give you an indication based on the progress of unemployment, inflation, about where we're heading. And when we get to the point of making a decision, if we deviate from this rule or these rules, I'm going to explain it all to you, why we think why we think we did it this way. That would be a way to just kind of softly constrain them a little bit, and it would be like a nod and a kneel to John Taylor without having John Taylor, tie your hands behind your back. So there's some changes there in communications policy that you might see. But I think, honestly, short-term interest rates, long-term balance sheet, those are going to be the two guiding stars. And if you're looking for a tell about the Kevin Warsh chairmanship, those are the two things to think about.
So, Howard, talking about those short-term interest rates, President Trump definitely wants them cut. He wants them lower.
Sure.
For Kevin Warsh, in terms, he seems to be buying into the idea that, with AI now, it's going to boost productivity, and that's going to help fight inflation. And therefore, you can get those lower interest rates. Am I summarizing his views correctly?
Sure. Yes. I think that's largely it. Now, he has said we can't be so data dependent, because and this is how he's trying to sort of loosen the bounds of how the current Fed is operating. We can't be so data dependent because the data lags and the data is backward looking, and we need to be looking ahead. Well, of course, they always need to be looking ahead, because monetary policy takes months to work through the economy. Whether it's 3 or 12, we can talk about that, but it's not today. Inflation hasn't moved for a year, and in fact, it's gone up in the first year of the Trump administration. It's probably going to print about 3% for the month of December when the next report comes out.
Which is above the Fed's 2% target.
In their world, significantly above their 2% target. So then you'd say, okay, well, it's 3% and it hasn't moved. Well, what's going to happen? Okay, well, let's agree that the tariff impact has not been as great. All the tariffs that Trump imposed on imported goods, this new tax on imported goods, that's come in, and companies have adjusted to that. And they're still adjusting to it, but it's probably on the downslope in terms of the pace and level of adjustment. And eventually that will fade away. It's not ongoing inflation. It's a one-time jump in the price level. And we're going to be through that, say, halfway through the year. What else is going to happen? Well, there's still some services inflation out there. You may not get it on the good side, but services is still up there. But the big thing, as you mentioned, is productivity, and whether or not all of the regulatory stuff that the Trump administration is doing, whether or not the productivity boost coming from whatever, it doesn't necessarily have to be AI. Several people, in fact, the guy I'm here to see, the Richmond Fed president, Tom Barkin, has talked about this. This has been going on for a couple of years, because companies after the pandemic realized we got no workers. We need to figure out ways to do more with less, do more with fewer bodies. So that was already happening.
Right.
And now it's probably going to get another leg, and perhaps an even more profound leg, out of artificial intelligence. What does that do? It means that for a given level of output, your costs are lower, right? You can produce more with less. Right. And the whole potential of the economy lifts at that point. There isn't the motivation, there isn't the incentive to have to continue increasing prices. So productivity is kind of always the magic bullet in any of these things. And if you can credibly lean on a productivity argument to say, we don't need to tighten up and slow demand because our supply capacity to generate supply is lifting before our eyes, you can go slower on interest rates. In fact, Alan Greenspan did the same thing in the 1990s as the first, or whatever wave of IT was sort of coursing through the economy. So there's a lot of talk about Alan Greenspan right now as sort of the oracular model. He looked ahead, saw what was coming, set monetary policy around an expectation that in fact proved prescient. And Kevin Warsh and some of the others are saying maybe we need to do the same thing now. How low are going to rates go? Well, that's the big question. 1% seems mighty skimpy for an economy growing at whatever it is, 2.5%, 3%, 4%, pick your number. But is there room to adjust further? He's going to have to convince people on this.
Well, that's the thing. I mean, he might think that AI and productivity are the silver bullet to get rates lower, but he's just one member of an interest rate setting committee, right? He would need to persuade the others,
correct,
to go along with him.
That's right.
And what do people think of him in the Fed, given that he has been so fierce in his criticism for years now? Are people kind of annoyed with him?
Yeah. So some people are annoyed with him, I would guess, and some people understand that in today's Washington, if you don't come in with a sharp elbow and a snarl and a harsh comment, you're not going to get anywhere, right? You're not going to get the ear and the eye and the support of the boss, right? That, as they say, it's always an audition for one person and one person only.
Okay.
So the question then is, like, when he comes in the door, and I think this is somewhat open. I've met him a lot, talked to him a lot. Extremely nice man. I mean, he's a great guy. You'd sit around with him and eat. I doubt he eats chips because he's got like no body fat. But whatever he's eating or allowing himself to eat at the moment,
low fat yogurt, whatever. Yeah.
You'd find him a perfectly personable dinner guest, or
a reasonable person, in other words, right? Right. Because some of the quotes, Howard, regime change and needing to knock heads together.
That's right. That's right.
Right. There's the rhetoric, I suppose, and then maybe perhaps there's the man.
Well, he's going to have to own that, and he's going to have to figure out what to do to smooth over some of that about it. And I think this is an open question because there is which Kevin Warsh is going to show up on day one.
Right.
Is it the we got to knock some heads Kevin Warsh, or is it the you know what? I'm here now. That's all. What are we going to do? What's tomorrow like? You're great. Let's, talk about what we can do better. And I think that if that was the attitude, everyone will, grab their oar and, try to start rowing in whatever direction he wants to set. There is the question of the relationship between him and the White House and the Treasury. And this is something I'm sure that will be discussed a lot in the Senate confirmation hearings. Now, we haven't talked about this, but he doesn't have the job yet, and he's got to get the job. He's got to be confirmed by the Senate, and there's a whole nother set of problems around that, given this, criminal investigation that Jeanine Pirro, the U.S. Attorney in Washington, launched of Jerome Powell, and whether that disappears or not. At this point, Jerome Powell doesn't have to go away in May. He will not be the chair anymore, but he can stay in his seat as the governor for another year and a half. They talked about a shadow chair for Jay Powell. Well, Kevin Warsh may have his own shadow chair.
In the body of Jerome Powell, perhaps.
That's right.
If you're enjoying this episode, check out our sister show, The Big View, where our global commentary team take you inside the forces shaping markets, policy, and geopolitics. This week's show is all about rare earths, and you can catch it wherever you get your podcasts. Coming up, we look at Warsh's room for manoeuvre in shaking up the Fed. Speaking of the bond market, one of the things, he wants to shrink. He thinks the Fed is too big. He wants to shrink its balance sheet, but that would be very difficult to do, right, Howard?
Well, here's
Unwinding all of those bond purchases.
It would be difficult. It would be tricky. He said, if you set what I inherited as a Fed governor in 2006 of about 800 billion and like pencil in a growth rate that seems kind of normal or like tracks the economy or whatever to today, the balance sheet might be $3 trillion, right? Through that organic growth process. Well, it's still so the current one's about 6. So there's a lot of room to come down. Should you want to do it. Now, it's complicated. And he said, it's tricky. It's got to take time. It's got to be well crafted. The other challenge is that right now the balance sheet is like interwoven in how they manage interest rates. So they'd have to find a new way to do that.
Perhaps the biggest challenge for Kevin Warsh will be his relationship with the president, Howard, right?
Yeah.
Maintaining the monetary independence, the independence to set rates.
This gets like complicated right out of the gate. Two things come to mind. One is that this is Donald Trump's Fed chair now, right? There's no Steve Besson made me do it out there, right? There's no Steve Mnuchin made me do it. There's no gosh darn it, what did I do? I should have, you know what? He's wanted this guy for, many, many years now. He's a friend of the family. Right. He's an insider.
Right.
And he has, some people said this may have been the longest job interview in the history of job interviews. Right. That he's been really wanting this for years and years and years. Now he's Trump's guy. What's going to happen? Well, look, there's all sorts of Nixon in China, analysis out there now saying actually Kevin Warsh is the guy because of all this stuff who can go to Donald Trump and say, listen, you don't want the inflation. You don't want the expectations out of control. I got to keep the market, on board. I got to keep my committee on board. So we're not going to be able to do as much as you think we should do. I think, in a sense, if Jay Powell hangs around, he becomes a great foil for Kevin Warsh. Because if he said, you know what, Powell is just like, and there's all these regional bankers and they're crazy and they're hawks and they won't do anything. So it's going to take some time. We'll get there, Donald, but it's going to take some time. I could see that argument working in his favor as well. There's a cut or two out there to be had probably. Interestingly, back to the Taylor rules for a second, if you look at all of them right now, they pretty much say rates are kind of where they should be. So from a Taylor rule, from a Hoover Institution Taylor rule perspective, rates aren't so high right now. They're about where they should be. So, it's not like there's a clear, we need to slash 50, 75, 150 basis points arguments right now. The data is not saying that.
He just needs to explain the Taylor rule to Donald Trump in the Oval Office.
That'll be a fun conversation.
Howard, for the average consumer, for the economy, people who are not obsessed with the Taylor rule, are things going to change much for them if and when Kevin Warsh takes over the reins of the Fed?
Well, I dare say if you're not obsessed with the Taylor rule, I don't know what kind of life you're living. But that aside, that aside, most people will not see much change in their life, in their bank account, in their borrowing costs, whatever, in any short order. Now, listen, the risk is that everybody's misreading this, except for a couple at the Fed, Stephen Byron and Christopher Waller, and the labor market's due for a big slide, and unemployment rates gonna go up significantly. And then you will see some change because people won't be working. But other than that, I think if they sort of motor along where they've been, not much is going to change very fast.
Howard, thank you so much for your time.
Sure thing. Happy to do it.
A big thank you to Howard for joining us on the pod today. You can catch all of his work on Reuters.com and the Reuters app. Now for that quiz. I asked you which Federal Reserve Bank has the world's biggest known stash of gold. Was it A, the Federal Reserve Bank in San Francisco, B, the Federal Reserve Bank in New York, or C, the Federal Reserve Bank in Dallas? And the answer is B, the Federal Reserve Bank in New York. As of 2024, The vault housed approximately 507,000 gold bars. In today's prices, that's about $1 trillion worth, all stored in a vault on the basement floor of its main office building in Manhattan. This is Reuters Econ World. Every week we go deep on the economic principles and ideas driving the biggest stories shaping your world. If you want to tell us what you thought about this week's show, just drop us a line on your favourite podcast platform or reach out to me on LinkedIn. This episode was produced by Eliza Davis-Beard and Ethan Plotkin. Sound design, music composition and engineering was by Josh Summer. Our executive producer is Leela de Kretzer. Remember, for all your daily news, make sure you're listening to Reuters World News, available on the Reuters app or wherever you get your podcasts.